Today we're talking about two stories that, on the surface, look completely different. A bank suing a Wall Street giant over a $126 million loan gone wrong, and an inflation report that economists are already calling irrelevant. But underneath both of them is the same question. What happens to regular people when the financial system starts cracking under pressure? I'm Matthew White, and this is Road to Riches. Good evening, everyone. My name is Matthew White, co-host of Road to Riches. My other co-host, Nyamki Buchanan, is unfortunately out again today. He caught a bit of that nasty flu that's been going around lately. So wishing him well, and hopefully he gets back with us soon. But I wanted to go ahead and do this episode for you guys anyway without him. And we have a full slate today, so let's get right into it. So number one, both these articles are from the Wall Street Journal. The first article is Western Alliance versus Jefferies Financial Group. And this article was really, really interesting, and I thought that it had some useful financial information in it and some useful financial techniques that would be helpful for everyone to be aware of. So, getting right into it, Western Alliance had made a loan to Jefferies Financial Group, and Jefferies Financial Group told the bank it would repay, and it collateralized the loan that it received with accounts receivable of one of its subsidiaries. In this case, it was First Brands Group, and an automaker who had recently gone bankrupt, and so that kind of put a wrench in the whole operation. Their accounts receivable was no more because the company that held them went bankrupt. And so now Jefferies Financial Group is in a spot where Western Alliance, the bank, is asking, hey, where's our money? And Jefferies says, well, I can't pay it. Our subsidiary company who had the accounts receivable, well, they went bankrupt. So now we're just going to not pay you. And so the way this went was 1 week before the next scheduled payment, that's when Jefferies says we can't pay. And so the CEO of Western Alliance evidently met with the head honcho of Jefferies, and the CEO of Western Alliance came back and said, okay, well, I guess we're going to sue them because they're saying that they're not going to pay us and all of that good stuff. And so, unfortunately, now there's a lawsuit going between Western Alliance and Jefferies Financial Group through one of their subsidiaries. It's not directly Jefferies Financial Group. It's one of that group's subsidiaries, and they filed it in New York Supreme Court. And so, what did this do to stocks? What did this have to do with the market? Well, Western Alliance's stock dropped by over 8%, and this happened earlier this week. And Jefferies, their stock dropped by almost 14%, and it was their worst day since 2009. And so, moving forward, the Western Alliance had to charge off the loan. And so what does a charge off mean? What is that? Why would a bank charge off a loan? And what effect does that have on the financial statements? Well, a charge off essentially means the bank has admitted that the money is gone, that they can't depend on the money coming in. They're charging it off. they're saying, okay, we hope to get this money, but just in case we don't, it's no longer on our books. It's not going to affect anything going forward. And we're going to eat it, essentially. In financial speak, it gets removed as an asset in this case. Account in this case, notes receivable, and interest receivable. Well, it gets removed as those assets, and it just hits earnings directly. It's immediately expensed, and so the question becomes, okay, why was this loan made in the first place? Why would a bank, a regional bank at that? Western Alliance is not Bank of America or Citi or anything like that. Western Alliance is a regional bank in the, I believe, southwestern United States. So why would Western Alliance, make this large of a loan, again, $126 million, based on accounts receivable? It's not like there's any kind of large collateral or real estate property, anything like that behind this loan. It's accounts receivable. It's essentially IOUs to another company saying, oh, well, if this loan goes bad, well, you can just take the accounts receivable. In this case, the company went bankrupt, so there's no collateral anymore. So why would they make this loan in the first place? This is a very risky loan. Well, what happened was, first of all, the reason why they would do it is, they earn interest income, and so they can earn more interest income the riskier the loan, and that's the trade-off. The riskier the loan, the higher the interest income. However, there's a higher chance that the loan won't work out. And so, these are things that bankers think about. Very, very low risk loan. Now, very, very low risk loans, they have a lot of competition in the outside market. Well, when you get up to the higher risk loans, there's not so much competition. And so you can charge a higher rate because it's riskier. In this case, that's exactly what happened. It was a very risky loan, and therefore the trade-off. And then, how do we explain accounts receivable as collateral? As I mentioned earlier, and a lot of banks do collateral off of accounts receivable. Normally, they're very, very safe, and in large part, accounts receivable are a large part of how a company does business. And because some companies operate in very, very large orders. And so they will rack up a lot of accounts receivable, and those accounts receivable will end up turning into cash. And it's not like, a company goes out and takes an IOU from another company in hopes that they'll pay. Again, at a lot of companies, this is a large part of how they do business. And so now some companies will, because it's not a regular part of how they do business, they will just trust, for example, friends or colleagues with accounts receivable and hope that they pay them back, because it's not a normal way that they do business. Not in this case. A lot of large auto manufacturers, for example, auto manufacturers with car dealerships, GM will send a large amount of cars to a car dealership, and that car dealership will give an accounts receivable, a note. They will give a note payable to GM, so GM will hold a large account receivable with that certain dealer, and the dealer's good for it. But it's sort of on contract where the dealer is prepared to sell vehicles, and they will pay GM back based on their sales. And again, it's not like they write a check right then. It's more like they write several checks over time to fulfill their account payable. And so that's kind of what's happening here. Anyway, got off track there. So accounts receivable normally are very, very safe. as collateral for loans. A lot of banks will still do. A lot of banks will, go up to 80% of total accounts receivable, and that 20% is usually like, their safe zone for uncollectible account insurance. So, some accounts receivable, they may genuinely not be able to be collected. And in the accounting world, we call that an allowance for uncollectible accounts. In the banking world, it's not even a question. 80% of accounts receivable, and we're done. We're moving on. But normally very, very safe because it's essentially a cash equivalent. In a lot of ways, both accounting, both definitionally in accounting and in finance, it's a cash equivalent. It's essentially like using a CD, certificate of deposit, as collateral for a loan. So again, to kind of make an analogy of the whole thing, imagine lending someone money because they promised to repay you with their next paycheck. But in this case, they got fired, right? So normally you can count on that paycheck, but what happens when they get fired? And that's kind of, if they work in a riskier industry, their risk of getting fired is higher. And so that can be like loaning somebody money off of their accounts receivable, and their accounts receivable are very dubious as to whether or not they'll receive them or not. Not like in GM's scenario, more like in this isn't how you normally do business kind of scenario. And so, moving on from that, we're going to cover a little bit of private credit. And we've covered this in previous episodes as well, but I want to touch up on it one more time here as well. So private credit, first of all, private credit is lending that happens outside of the public market. So outside of commercial credit, outside of your local, outside of your local community bank, outside of even Bank of America or Citi or things like banks like Zion Bank out in Utah or what have you. Even different than that, because that's still commercial. In private credit, there are no SEC filings. There's less transparency and there's less regulation. And again, this is why private credit exploded, especially after 2008, is because 2008 was the Rubicon for quote unquote public credit. It was when commercial credit started to get extremely regulated because of 2008, because of what happened. And again, in my opinion, because they blamed commercial, they being the regulators and the government, they blamed commercial credit for the faults and the sins of not private credit at the time, but large credit investment banks blamed commercial credit for the sins of even private credit at that time, for creating the bubbles that they did, and for not paying, and for the government and regulators essentially turning a blind eye to situations that could have ended, and did end up ending badly. And so, but regardless, private credit exploded after 2008, and that's why less regulation and less neck breathing by the government. And so, moving on, the returns from private credit can be attractive, and they are attractive. Once again, you have what we discussed earlier in the episode. You have higher return, but it's only a higher return because of the higher risk. And so a risk is very, very high. That's kind of why they're going to you. That's kind of why these borrowers go to private credit, is because they're going to engage in something very, very risky, very, very high risk, high reward, but nobody will lend them money. Well, private credit will lend them money. Why? Because they're less regulated. A lot of the times, and people don't really think about this, commercial banks will really, really want to lend somebody money who is a high risk player, but their idea or their capital improvement or what have you is also high reward, but their hands are tied in a lot of cases. What I mean by that is, if depending on how large the loan is, they can get the regulators can discipline banks through fines, through strikes against them in the state records or anything like that. They can punish commercial institutions because of the risky loans that they make, and that's and again, that's why even commercial banks that want to do business with risky people have to say no, because they know that if they say yes, they will get punished, and sometimes very harshly. And so that's another reason why private credit has become so popular, is because of the government. And so the article itself mentions that Wall Street has been nervous about private credit for months now, because of the large scale corporate restructuring. Whether we're talking Target, whether we're talking this auto loan, this auto company that went bankrupt, and hence the whole point of the suit. Their accounts receivable disappeared, or because we're just talking about how the rules are being skirted, and private credit is taking advantage of a loophole. There's been a lot of high-profile funds facing withdrawals, and then even a British mortgage company recently started having financial troubles, and they almost, I think they did have to declare bankruptcy. And so it's serious stuff. And one of the downsides of private credit is that these problems that do occur, for example, one of your borrower's subsidiaries is to which your collateral is based on is about to go bankrupt. Well, that's a serious problem, but it was never mentioned until something bad really, really happened. And now all of a sudden we're writing off $125 million because regulations weren't kept up. And it sounds like I'm talking out of both sides of my mouth here. I'm not. Some regulation, sure. We concede that there are certainly regulations that need to be put in place. The question is, how much regulation is enough to keep the banks from doing things that we would rather them not do? In 2008, it was mortgage-backed securities, and it was a house of cards that depended on millions of Americans all paying their mortgages. And if even 5% foreclosed, that means that large businesses on Wall Street would go bankrupt. And eventually, those low rates from the Fed ran out, and we started having not just margin calls, but large scale foreclosures. And so, whose fault was that? Right? Was that your local community bank's fault, or is that large financial institutions? We have to find this balance between regulation and just making it extremely hard to compete in the banking sector. And a lot of these regulations are that way. Bank of America, I wouldn't be surprised if Bank of America directly lobbied for these regulations. Why? Because it makes it more expensive to compete in the banking sector. And this is a large argument against regulation, because companies will use them against their competitors because they can afford the fines and their competitors can't, or they can afford to hire another person to look into the 1,000-page book full of all the banking regulations, and their competitors can't. And it's to use a quote from the Green Mile, they'll kill you with your love. And in this case, these companies are just taking advantage of the fact that people just don't want other people to get screwed in the market. Well, in doing that, the people who would screw other banks out of their the people who would screw other banks out of competing with them, well, they're doing that in another way. They're weaponizing the very thing that you wanted to use to make sure that they didn't do anything nefarious or they didn't cause anything nefarious. They're using that very thing against their enemies, and it's certainly something that you guys, as well as the rest of the world, needs to be aware of and needs to know that actually regulations are indeed being weaponized, not just in banking, but in every industry, against smaller competitors who can't afford to compete. And, more on that later. But moving on, this is the part of finance that nobody talks about until something cracks. And right now, things are beginning to crack. Things are breaking. And it's important for us to see that. So, moving on, it also affected other bank stocks. The S&P index that captures all the major bank stocks. Well, a lot of those bank stocks fell also by around 4% that same day. And even though they had nothing to do with that specific deal. And so you're asking why? Well, the market started asking, who else has exposure to these private credit deals? Who else has something to lose? And so we're talking about market contagion, which is the idea of fear spreading from one institution to the entire industry, to an entire sector, saying like an analyst put it, mentioned in the article, this isn't a new cockroach. It's just now. It's just that now it's rearing its ugly head. We've always known about it, but we're just now seeing the negative effects of it. And where there's one, there's usually more. And what I mean by that is this isn't the first lawsuit or market scandal that Jefferies Financial Group has been involved in. It's not just this lawsuit, but Jefferies was also involved in some things that happened in the UK, primarily with another lender that went bankrupt. And so, the 14% drop in Jefferies and Jefferies Financial Group's stock had this kind of market contagion priced in where, it's not just the lawsuit, but there's also uncertainty about what else lies behind, beyond the headlines, what else lies behind the surface. And that's the question with private credit. And that's why it's extremely high reward. It's also extremely high risk. And, people need to know that before they just see the reward and say, that's where I'm going. That's where I want to be. Well, you need to know the other side of that equation as well. And so, and again, it's not like Western Alliance is this big national bank or even or even investment bank. Western Alliance is a regional bank, once again, in the southwestern United States, and you can kind of compare them as the or call them a backbone of sorts of small business lending and local mortgages. When they take hits like this, you can expect the ripple effect throughout the small banking world. Certainly, again, talking of market contagion, And so the auto industry as well, the auto industry as well is showing a few cracks itself. Once again, the whole purpose of the article, uh, uh, First Brands, the car company that went bankrupt. Well, now not only are they bankrupt, their accounts receivable are gone. So, what does that mean? Maybe that's worth watching. And so, and this has many implications, whether it be what effect EVs have on the market versus regular combustion engines in terms of needing car parts and other things like that. And it also has to do with what it also has to do with the general sentiments of the market. Maybe they're not selling as many car parts because not as many cars are being sold, or not as many people are taking their cars to the shop and just letting their check engine light stay on because or not driving their cars as much because it's just gotten so expensive they can't afford it. And so the many things that keep an eye on. And then last story real quick, we're running out of time here, so last story again from the Wall Street Journal. So February CPI came in at 2.4% year over year. And this is exactly what economists expected according to the article, and unchanged from January. But it was immediately called completely unconsequential, unconsequential by top economists, because now the United States is engaged in a war with Iran, and it began on the last day of February. So and on top of that, the Strait of Hormuz, which is known as the choke point for roughly 20% of the world's oil, or I should say is the choke point, is now effectively closed for commercial shipping. Iran has actually mined it to make sure that nobody can go through it. And oil prices have already jumped. In February, the average was $65 a barrel. Well, now it's around $82 a barrel. And prices at the gas pump have also risen from $2.91 for the national average to around $3.50 per gallon. And so, very, 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 very bad stuff. And I would like to say, though, on the other side of that equation is the fact that it's not like oil hasn't seen this price in decades or even half decades. Oil literally saw this price back in 2024, and it even reached $120 a barrel in prior years to that. So 2022 and even a little bit of 2023, it saw $120 a barrel. And so that just to say that, okay, so that's kind of unfair to say that, to point out that to mention oil as if things have just gotten really, really bad really, really quickly. Well, with context, things undoubtedly gotten more expensive, but it's not like we haven't seen things worse than this when absolutely nothing was happening in terms of war. It was just bad economic policy. And so moving on, the CPI is what grabs headlines. The Consumer Price Index, which measures a basket of consumer goods. How this basket of consumer goods that usually a family of four consumes. What has the price? What is that price done over the last month to get month over month, and then year over year? What is it done year over year? And that's the Consumer Price Index. Now, that's not what the Fed uses to judge whether or not they raise or lower rates. What the Fed uses is what's called the consumer price expenditure. And what the CPE does is it takes out those extremely volatile variables. In this case, energy. So things like oil, things like gas, things like electric bills, things like that. And that's what the Fed uses. And you'll remember last month we had the best CPE number since April of 2021. And so the Fed has taken a strong stance here and said that we're going to wait and see what happens with this Iran conflict, and we're going to wait and see, and then raise or lower rates from there. And admittedly, I think that maybe that's the best way to go. This conflict certainly is having an effect economically on certain things. But those are the metrics that the Fed uses. Those are the metrics that the Fed uses that we don't really see. And then that CPI number, that's the metric that catches headlines. That's what news organizations use. Now as to why news organizations use CPI and the Fed uses CPE, I imagine it's because the CPI is one of those legacy statistics. The media has used it for so long. Changing it over to CPE would simply, create confusion. And also CPI does have all of the variables in it, including the volatile variables such as energy. But all of that being said, whether it's a $126 million loan blowing up in the private credit markets or an inflation report that got overshadowed by a war before the ink was dry, the theme today was the same, which is the financial system is under real stress right now, and understanding why is the first step to protecting yourself. That's all for today. Remember to like and subscribe, and if you have a comment, be sure to leave it here for us to read and maybe feature it on next week's show. I'm Matthew White. Stay curious, keep asking questions, and we'll see you next week on Road to Riches.